Ken the Wiz Reeves saying thank you so much for allowing me to be part of your day. I want to remind you, we do this each Tuesday and Thursday. That's right, each Tuesday and Thursday from 2 to 4 p.m. Eastern Standard Time. It's the Ask the Wiz Wealth Institute Classroom Without Walls radio broadcast. So family members and listeners alike, are you about ready to go ahead and take this thing across the pond? Talking about making it international? Talking about learning how to get P.A.I.D from the emerging markets? Well, what say you? We go ahead and do just that. Now, when emerging market stocks enter a bull market, they do so in a big way. And recent action in emerging markets suggests they may be on the verge of doing just that. So now, let's we the Ask the Wiz Wealth Institute family and listeners alike, let's analyze this situation as we see now what others see eventually. Now, the 5 years before the financial crisis of 2008, they were a golden age for emerging market investing. Between 2003 and 2007, emerging markets were the top performing asset class in the world. Consecutive annual returns of 55.8%, 25.6%, 34%, 32.2%, and 39.4% over those 5 years were enough to turn a $10,000 investment into $48,304. This was the era of the BRICS. You know, Brazil, Russia, India, and China. And by together representing more than 25% of the world's land coverage, 40% of the world's population, and a combined GDP of $20 trillion. Yes, that's what the BRICS present. And we're talking about Brazil, Russia, India, and China. Many analysts predict the BRICS will dominate the global economy by the year 2050. Think about that. That's a compelling thought. Now, pat yourself on the back if you never bought into all of the investment hype that comes out pertaining to either the emerging markets or the U.S. markets or any other markets. And pat yourself on the back if you're pretty much stable, okay? You hear the hype, but you focus on your due diligence. Well, if you're one of those hype people, I want to present to you a position that's a pure play on the BRIC stock markets. It's a position, an ETF, exchange traded fund, that trades under the name iShares MSCI BRIC ETF. BRIC ETF. Now, it trades under the symbol BKF, exception market cap. It does not have a market cap of $1 billion, okay? It's a couple of $100 million. But we can still, if we're clever, and if we're intelligent, and we adhere to all the steps of our drill down, we can still monetize, okay, this couple of $100 million market cap exchange traded fund. Now, this ETF, BKF, iShares MSCI BRIC ETF, was launched in November of 2007. Now, had you invested at the launch of this particular ETF, talking about BKF, okay, you initially would have lost 30% of your investment over the past 11 years. Over the same period, the S&P 500 index rose more than 84%. But as we look at the situation now, the emerging markets are coming back. Now, emerging markets have lagged the U.S. markets badly for nearly a decade. But here's the good news. Here's the redemptive news. When emerging market stocks enter a bull market, as I said earlier, they do so in a big way. And as I suggested earlier, recent action in emerging markets also suggests they may be on the verge of doing just that, coming back in a big way. You see, let's examine three factors that you need to consider before investing in the emerging markets. And I dare say any market. They are, And I'm going to break them down further, but let me list them for you now. Fundamentals, technicals, and market sentiment. Let me repeat now. Write that down. Fundamentals, technicals, and market sentiment. These are the three factors that you must consider before investing in any market. But we're going to focus on emerging markets right now. Number one, fundamentals. Stop me if you've heard this argument before. International stocks are a bargain compared with U.S. stocks. World-class companies are trading at a fraction of U.S. stock market valuations. In developed markets, Airbus is cheaper than Boeing. Adidas is far less expensive than Nike. In emerging markets, high-tech giant Samsung trades at a mere six times forward earnings. That's astonishingly cheap by the standard of U.S. tech sector companies. The big picture valuation of global stock markets is equally compelling. You see, the risk in emerging markets are always higher. After all, China and Hong Kong together make up almost 30% of the MSCI Emerging Markets Index. Chinese companies, in and of themselves, account for 6 of the top 10 companies. So do you really want to bet on a slowing economy involved in a trade war with the United States? The answer may surprise you. Despite China's slowing GDP growth, its tech giants like Alibaba and Tencent are thriving, beloved. The long-term technical megatrend of increasing internet use trumps short-term economic challenges and trade wars. So, family members, please remember the first one. Okay? You want to make sure that you do your drill down on the fundamentals of the international companies that you're thinking about placing in your portfolio. Next, technicals. Perhaps the most popular way to define a bull market is to look at a market's 200-day moving average. As it turns out, the MSCI Emerging Markets Index just broke above this critical level. Major U.S. indexes like the S&P 500 and the NASDAQ remain below this critical level. This widely followed technical indicator alone will compel many technically inclined traders and investors to invest in the emerging markets. Monitor the technicals. And number 3, market sentiment. Number 1 was the fundamentals. Number 2 were the technicals. Now we're on number 3, the market sentiment. Now there is just no way of sugarcoating it. The average U.S. investor hates emerging market stocks. And with the gap in returns between U.S. and international stocks near the widest level it's been in 14 years, can you blame them? Yet anytime I see such extremes in sentiment, I have to wonder to myself, are we at peak pessimism? If so, the time may be ripe for emerging markets to enter into a bull market. Throw in the prospect of a negotiated trade deal with the U.S. and China in the coming months, and emerging market stocks across the globe could take off like a rocket. Now, much like risky positions in biotechnology, emerging markets are a boom or bust asset. When emerging markets are hot, they're hot, and investors pile in and drive prices higher. When they're not, they're not. And it's best to stay away from it. But if you do your drill down, and as a result of your drill down on the emerging markets, looking at the fundamentals, looking at the technicals, and looking at the sentiment, if Your drill down reveals to you that you see a bull market developing or on the horizon, then you might be well advised to take strategic positions that will allow you to monetize the emerging markets. And the best way to do that is with a leveraged emerging market exchange traded fund, ETF. When you do that, it then will allow you to multiply your profits as it relates to the emerging markets, because you are taking a leveraged exchange traded fund. And that's what the uber wealthy and the institutional investors do. It allows their earnings to be multiplied. Sometimes the multiplier is times 2 and even as much as times 3. But no matter what you do, no matter what position you take, you make sure that you have that trailing stop tucked up under you to protect against market erosion. Make sure that trailing stop is tucked up under you such that your risk is never equal to your exposure. And you go and monetize said emerging markets. Giving you information that will allow you to not only obtain, but also maintain your economic liberation.